First speaker is Suan Teck Kin. He's Executive Director, Head of Research, Global Economics and Market Research at UOB.
Okay, so today my topic is on macro drivers. If you look at today's main topic for this forum, the word Fed is there, under the shadow of the Fed. So I will give you a bit of how we look at the Fed rate outlook, what are the drivers, all right? And so have some idea what to look out for. Last night, we had the non-farm payroll report, right, from the US. So that's one indicator. It will show you, give you some idea. It will give you some idea. You can take the seat. No, it's okay. Yeah. You can, that one is one key driver. The other one, obviously, is inflation. So I'll give you some idea what to look out for again for those inflation. Then that's the interest rate part. The other part that people are, have a lot of concern, which our speaker Leonard later will talk about, is on recession as well. Right? What kind of recession risk are we running? Is it in the US? How about Singapore? How should we look at Singapore? All right. Okay. So here it is. Some of the key drivers, the policy calls, and also on the recession risk.
Sorry, let me just check on your clicker. I think it's not working.
Oh. All right. So you can see US recession and then last bit on Singapore. So the time, okay, I have about 20 minutes, so hopefully I can end in time, yeah? All right. For the Fed, so a couple of things we look at. One is, just now I talked about non-farm payroll, and the other one is inflation. For the Fed, okay, if you look at the unemployment rate, this is from October. I submitted the slide earlier. So the numbers is for October. Last night was for November. But you can see that the 3.7% unemployment rate, same as last night's report for November, is actually, compared to all other recessions in the past for the US, the 3.7% is about the lowest that you can get. That means the best that you are going to get, right? 3.7%. Of course, during the pandemic, the unemployment rate in the US jumped to a double digit, all right? But now the recovery has kept unemployment rate at the lowest, almost at the lowest on record. All right, so for the Fed is this, there are only two objectives. You think of all the complicated stuff that they talk about, there are only two objectives for the US Fed and for many central banks. One is to keep the labor market functioning properly, make sure that unemployment rate is at an acceptable level, and at the same time, must maintain the inflation rate at an acceptable level. Right, so only two objectives, so you think about this. So now, this one looks okay or not to the Fed? Obviously, the Fed thinks that it's okay. That's the reason why they are so aggressive on the interest rate. All right, so this one looks okay. Then we move on to the next one. Okay, here, inflation rate. Take a look at the inflation rate. Later I have another one that's a bit more clear. If you look at the inflation in the US, before COVID, before 2020, and actually around 2020, the inflation rate, the black line, is actually quite stable. All right? Quite stable and low. Then what happened? Starting around 2021 last year, because of all the demand coming back, because of fiscal stimulus, government giving free money, right? When this President Biden came to power, put in more stimulus, free money to people. So what do people do? They go and spend. So as a result, demand started to come back as the pandemic kind of like dying down. So you see the inflation rate just shoot up. And also, at the same time, there's a very important factor, is the supply chain disruptions. Remember the supply chain disruptions, the shipping rates, it's like, I think how many times before the pandemic, and then you cannot get enough ships. The ships are all stuck outside the port, cannot unload in the US case. All right, so the inflation rate has come up because of the supply restrictions and also the demand coming back. Just like in Singapore, right? After April, when restrictions were removed, I'm sure many of you travel overseas quite a number of times already, right? At least once. Correct or not? All these are revenge spending, right? All the pent-up demand, revenge travel. All right, so you can see that even last year when it started to pick up, there were already calls, 2021, see this chart, 2021. There were already calls for the Fed to raise interest rate. There were already calls, but the Fed didn't do anything until March, correct? So at that time, we were already telling our clients towards the second half of 2021, we're already telling clients to get ready for the Fed to move, but the Fed didn't do anything. So they waited for too long until it's a bit too late. So now they are catching up, and they are still continuing to catch up because inflation rate, the latest number was 7.7%. The peak was 9.1% year on year for the inflation rate in the US, 9.1%. This is really 4-decade high or 3-decade, 4-decade high for the US. So you can see that the inflation rate is still at a high level. So the Fed is under pressure. My job market performing okay, so I have to deal with the other problem, right? Inflation. The tool that they have is interest rate. Like what people say, when you have a hammer, everything looks like a nail, right? So you just keep whacking, inflation high, I just raise interest rate. All right, so that's what happened. Okay, so for inflation rate, I won't dwell too much on it. Just now you can see that, the components. The components, you can see that here are just a bit more. Transport is the gray part, and the food, this is food, and then housing. All these are the components that are driving inflation in the US. If you look at Singapore one, the chart is roughly about the same, right? Roughly about the same. So transport, what happened to transport? First, in the US, part of last year, you have all the chip shortage. So the new car prices shot up, and then used car prices shot up. So that's contributed to most of the inflation here. And then, of course, the food and beverage, meaning like all those, because of, for example, over the past year or so, because of Russia-Ukraine conflict, so the feed, the wheat prices, the commodity prices all shot up, so also contribute to that. And then the third thing is that the rentals for US market is also very strong, so that contribute the cost. And also part of the utilities, your gas, your house for gas and light and all that, is also part of this housing cost here, right? Not just rentals. So there are all these things that are driving up the US inflation. So 7.7 looks good. Yeah, there's some thirding. But the more important thing is when the CPI report comes out next week, this is a PCE. Last night, the night before it came out, but it's about the same. It's a PCE. What should we be looking at? Are we looking at the top line, year-on-year number? Not so much, We should look at the month-on-month number. Month-on-month number meaning what? This month's number compared to last month, what is the change? All right, what is the change? So the percentage is what? In the past many years, look at this average, 2000 to 2019, 20 years. 20 years average, every month, the month-on-month movement is about 0.2%. Very mild, 0.2%. And even during the pandemic, 2020, the average is only 0.1%, month-on-month, not year-on-year, month-on-month. So that's the reason why when inflation started to spike up, people don't know how to read the report. You know what? Because in the past so many years, nobody bothered about inflation report one. Really, you ask the analyst, nobody cared. Really, it'll come out, because every month come out, it's 0.2, 0.1, 0.2, 0.1, it's very boring. Nobody look at it. Unlike non-farm payroll. Non-farm payroll, people will pay more attention, but not inflation report. So when we are at this stage, 2022, Look at the average, it's 0.5%, more than double, 4 or 5 times. So people started to pay attention. Of course, the central bank all started to get nervous. 2021 already 0.1%, 0.5%, 5 times, 2 times more than normal, 2.5 times more than normal. So they started to pay attention. So this is the number that we should be paying attention when we read the CPI report. Why? Because for the latest number, this is a PCE. The reason why I use PCE, personal consumption expenditure, is because every quarter, during the Fed statement, when they release a statement, they'll tell you what they think the PCE will be for this year and next year. So December, next week, when they release the report, they will tell you what the Fed is thinking about their forecast. So you can see that the forecast for the latest September, that's the only thing that we have right now until next week, is 5.4 for this year. Next year, they are expecting 2.8. All right? 5.4 and 2.8. Can we get there? That will depend on your month-on-month movement. Right? Not so much on the year-on-year. Now, the latest number, last night also the same, 0.3%. 0.3%. Huh? Now, if we follow this trajectory, 0.3%, every month, 0.3%, by end of next year, it will be about 3.7%, the headline year on year. You follow me? So these are the lines, these are dotted lines. These are the dotted lines here. If I follow this is 0.3 is the gray line, should be somewhere around here. So you follow this 0.3 next year, it will be at 3.7%. That's provided every month, 0.3. So if what happened, in an extreme case, it jumped to 0.6%. So if it continues that way, you'll be about 7.4% next year. Okay? So 0.3%, if you can ensure that, then the Fed target will more or less can be met. Meaning what? Then the Fed will be a bit more relaxed. All right? No need to be so kanchiong. But if it's like the number jump out to, let's say, 0.4, 0.5, 0.6, because 0.5 is the average so far this year. So you follow the same average, then we'll be in trouble. We'll be in trouble already because the Fed say that, we cannot meet our target. So what do? Take the hammer again and hammer. Right? Interest rate. That's the only thing that you know how to do. All right? Okay? Nothing else already. Okay, so the non-farm payroll last night came out already. Look at the jobless rate. All right? Later, I will repeat the same story why we should be looking at the jobless rate. Not so much of the how many, 200,000, 300,000, that one is not so critical. The critical part is the unemployment rate. Second thing, when you look at the inflation report, last night, on Thursday night, it was the PCE, personal consumption. Next week, I think Thursday night, just before the Fed decision, it will be the CPI report, this report. Okay, oops. So it will be this report. 13 December, it will be released 13 December. So it's very important to monitor. These are 0.3, 0.2% change. All right, so that is the part that we pay attention to, because there's a lot of numbers flying around. Okay, so that determines our. So that determines our view for the Fed funds rate. So what are we thinking about the Fed funds rate? Fed funds rate this year increased 6 times already, right? 4 times is 75 basis points. When the November decision came out, we already think that the Fed is going to slow down. All right? The Fed is going to slow down, so it will be about 50 basis points in the next December, next week, and then followed by 2 more meetings next year, first quarter, February and March. No meeting in January, so we can have a more peaceful Chinese New Year. So only February and March. For that 2 meetings, we are expecting 25 basis. All right, 75, slow down to 50, and then 25, 25. So that will bring us to the top, the peak rate at 5% for the Fed funds rate. Hopefully, if inflation rate behave, 0.3, 0.2, that's sort of number moving forward. If not, you have to get ready for this number to go higher. Right, because the Fed is very stressed about this. They were late to the game and the momentum is strong. Hopefully the momentum for the inflation is coming down. All right, okay. All right, Singapore and all that, I'll have a chart later. I'm not going to go through it. Okay, so this is for Singapore. You can see that the Singapore SORA 3-month, most of the mortgages are pegged on that. The SORA 3-month average rate. You can see that our SORA rate, I think it's already gone past close to 3%, near 3% already. Is this the highest? Actually, it's not. If you look back, 2006, the SORA 3-month actually hit about 3.35%. So we are still not at the highest level yet for our SORA 3-month. So you can bet if the Fed continue to raise interest rate, this rate is going to continue to move higher. All right, so later I'll have a chart to show you. Okay, let's move on. Here it is, the table. Okay, this table is under revision. We already adjusted the numbers last Friday. Every month we refresh this. You can go to our website to take a look at the latest. But I think if I remember correctly, the 3-month SORA is tuned slightly down, but it's still not too far away from the previous. This is our previous, right? That's why I put it under revision. And also for the 10-year Treasury. 10-year Treasury, we're also expecting the rate to go above 4% next year. Although last night it came down to about 3.7%, stay at 3.7 for the 10-year Treasury, peak at 4.4, 10-year Treasury. So similarly for the 10-year SGS as well, it will come down. It's actually slightly lower, but I think it's still about the same level. Okay, so the next topic that I want to address, also to share with you all, is recession risk in the US. So how do we understand? How can we understand about it? One way to look at it, there's a model that we can use to determine. And this model depends on US jobless rate. Okay, this model actually is called, you can go and Google Sam, this is Claudia Sam, this is a person, Claudia Sam from Federal Reserve. Actually devised this model some few years back. And it turned out that there's a link also, if you want to understand a bit more, you can take a look at the link from Brookings Institute. It tells you how this thing works and what are the numbers who look, etc., etc. Okay, link is below here. We can share the deck for you, share the deck with you after the session, so you don't have to copy down all this. All right, so you can just click on it, you can get to the website. So what it says is this: if the jobless rate in the US, okay, in a simple way of looking at it, so this red line is the derived one, so they do the calculation, and if it hits the 0.5 level, that's a marker, 0.5. That means if it's 0.5 higher than the jobless rate, something like this, because it's a bit more complicated, I don't want to waste your time to explain. If you hit above the 0.5 level, then it says that the US is already in a recession or at the start of the recession. Okay, so 0.5 from the current level actually is a 0.5 of the average for the past 3 months, and compared to the lowest of the past 12 months or something like that, so it's going to be complicated. But to make it easy is that just think about if the jobless rate move above 0.4%, all right, 0.5 point higher than the current rate, roughly, then we'll be in a recession in the US. So it's very important to watch the jobless rate. From their experience is that this model is quite accurate in a way predicting the US recession cycles. All these blue parts are the recession, and the brown part, the vertical, is where the two lines meet. All right, so that is the that's the reason why when you look at the non-farm payroll report, not so much of the, how many 100,000, but pay attention to the jobless rate. And good thing is the Fed also provide every quarter in their FOMC statement, they also provide forecasts for the jobless rate, right? The way that how the Fed looks. So the latest one for September, the SEP means Summary of Economic Projections. So that's their statement for their forecast. They provide the jobless rate at 3.9% forecast end of this year, 4.5% next year. So now 3.7, right? So move towards 3.9 is those 0.2. So you are still safe. However, if you continue to move towards the 4.5%, so we did some simple projection. So it means sometime in 2023, meaning in the first half of 2023, these two lines will meet, and the US probably will enter into a recession sometime in middle of next year or early part of next year. All right, some sort of recession. However, that's not the end of the story, because there are two questions we cannot answer. One is, how long is it going to be? And second question is, how deep is it going to be? Right, so these are two questions we cannot answer. We can tell you roughly when it's going to happen, but we cannot answer how long or how deep. But our assumption is that it's going to be a mild one, because in the absence of a financial crisis or some other crisis, the recession is likely to be a mild one. All right, so if there's a shock to the system, then all bets are off. Don't know how long and how deep. All right, so right now our assumption is that it's going to be a short one. All right, so I only have about 5 minutes left, so I won't go through the other part. So two things, interest rates driven by inflation, and also the other part is a recession, when is it going to happen? All right, so for Singapore, very quickly, I want to wrap up. What we are going to see is that in terms of growth, economic growth, GDP growth, whatever you call that, is going to see some downward trajectory, and it will continue on until next year or so. So we had the latest third quarter number, 4.1%. The previous quarter was 4.4. It's actually quite strong. But next year, or starting from fourth quarter, it's going to be slowing down. All right, it's going to be slowing down to about 1.6. Next year, don't be surprised if MTI reports sub 1% growth for the quarter. The latest number was already 4.1%, very strong, right? But don't be surprised, next year we're going to see sub 1%. In fact, our forecast for next year is 0.7%. MTI is looking for 0.5 to 2.5%. That means it's slower compared to this year already. And this year is already slower compared to the previous year, which is a rebound of 7.6% in terms of growth. So your top line, you're going to see that. All right, finally, I only have a few more charts. Okay, the good thing about Singapore, you talk about US recession, Europe also in recession. Good thing about in Singapore is that we are in a very strong and expanding neighborhood. Take a look at this last chart I'm going to show you. This one shows you that most of our neighbors, Philippines, Malaysia, Indonesia, etc., they already passed the pre-COVID levels already in terms of the output level. Right? If you think about in terms of wealth, they are, after the damage from the 2 years of COVID, their level is already back to before COVID. So recovered already, except for Thailand. Thailand is still a bit down because the tourism sector is still not operating at the maximum yet. The reason why, of course, is China is still not open. So once China open, we're going to get very strong numbers. All right, okay, so the China numbers I want to show you. Okay, Thailand and Singapore also, you see, this is the inbound visitors. Right, remember we opened in April, so a lot of visitors coming in, etc. Look at the number. Thailand also open. Year to date, we already received 5.7 million tourists. Singapore, 4.6 million. Wow, very good, right? Already very busy. You go outside, restaurants are full and people are everywhere. But if you look at 2019, before COVID, we got 20 million people in Singapore coming. Our population, less than 6 million. 20 million visitors came to Singapore. Now, only 6. Only 6 million so far. So add another 2 or 3 million for the holidays. We are still way below, punching way below our belt. That means what? Still a lot of upside in terms of the domestic, for our services sector, for our restaurants, for our hotels, for our transport, for etc., etc. Right? So all those domestic services sectors will have a better day in the year ahead. All right. So I will just stop here because my time really running out already. So later we have a panel. We can talk about other things. You can use that pigeonhole thing to ask questions as well. All right. Thank you so much for your time. I will pass on to the next speaker, Leonard. All right.
Our second speaker is from TD Ameritrade. He's the Senior Trade Desk Manager, Leonard Eng, and his topic is a dive into portfolio solutions.
Thanks, everybody. So this is an overwhelming the seminar. So this is December, and after me is the break ready. So tahan just for a while. So it's a good thing. Thanks, Stay In, for the introductory into what the drivers for Feds are. And for myself, I am delving a little deeper into mild recession. The R word is around here already. So I'll just go into the slight, maybe a layer difference. But before this, disclosures, anything that I'm mentioning is for illustration. Do not take it for a recommendation, yada, yada. So, so there will be some tips that I'll be sharing, especially rolling into a mild recession, and also defining what a recession is. So just take it with a pinch of salt, and it should be part of your repertoire. At least pick something off from my speech today. So for myself, it will be, I'm 8 years with TD Ameritrade. I've given platform demonstrations on the Think or Swim platform. If you have not gotten it, do try. Click on the link, open an account. You do not necessarily need to fund it, but you still have access to the flagship Think or Swim platform that I'll be displaying later. So commercial software do charge like 2,000 to 3,000 a month. For Think or Swim, it is free. It is in the power of your hands to drive your own investments from here. Right, so this is somebody very, very famous. So anyone, I would say, let's show of hands. Who knows this guy? Okay, I would say a little bit. So Mark Cuban is one of the biggest shark in Shark Tank. So Shark Tank is like a business pitching proposition that people want funding for their companies. So he is one of the biggest shark on the US scene. So he owns also a sports team. So for what he did here is that he received 1.4 billion of Yahoo shares when he sold his company to Yahoo. So we know Yahoo is a search engine before Google came out. And then he sees the dot-com bubble coming, and how is he crafting something that, two things that he knows. One, he has an existing portfolio that is sizable. Secondly, he got together with Goldman Sachs to do a collar trade. So the collar trade, if you are not really familiar with options, so everyone knows a call options. When you buy a property, you buy an option, the OTP, which you can have a right to purchase a property at a certain price that expires after a certain time. So that is a call option. So this is a put option, and it combines it with a call option so that he can protect first the downside and impending downtrend in the markets. At the same time, he can offset maybe with a bit of selling insurance by selling the call options. So if you're lost with call options, don't worry. Later on, I'll have a diagram to show what the collar trade is like. But at the back of your mind, you can do something about the impending downturn that is coming up. There will be three contexts that I'll be going into. Once we define what a recession is, which I'll kind of skip on, and then after that, we understand what the solutions that is available from here. First, the R word. So I think taking cover plenty of what is going on. So these are the exogenous events that happens outside of our control. The Russian-Ukraine war, as well as the resource constraints. So I summarize in the R word, as well as rate hikes. In the end, why do you see is a recession, but a mild one? But like Teck Kin mentioned, it is also tackling two things, unemployment and inflation. But employment is pretty strong. We are still buying an ever-expensive birthday cake for our loved ones, no matter how expensive it is. Right or not? So the ramen is going to double in price. We are still able to afford because we know employment is there. So thereby, in short, it's a mild recession that is upcoming. Recession is pretty confirmed because, you know, inflation is everywhere. It is the job of the central bank that is trying to rein in the inflation from there. So this is pretty much akin to what Teck Kin mentioned. This is the Fed funds rate with the unemployment rate. It is usable and viewable from the Think On Swim platform. It is retrievable from FRED, which is the economic official, the statistics firm that the US government uses. You can actually use it on the Think On Swim platform like what I did. So what you see here is the unemployment rate that it is pretty much not high, because you can see it's pre-COVID, actually pretty much the same level. And the Fed funds rate is skyrocketing at this moment, trying to rein in. So it takes around 9 months for the Fed funds to actually pass through into the system. So it is not now. It depends on the metabolism rate of the economy, of the US economy, that when they shift interest rate, how much cascading does it pass through into the economy, and then you see the effect. So what we see is that the highest time of unemployment is during the 2008 crisis, mirroring what Teck Kin mentioned previously. And the other thought to take away, imagine, let's say, increasing the Fed funds is equivalent to something that we don't really hear nowadays called quantitative tightening, QT. So we hear before QE, but QT is different. QT is actually pulling in all the money and keeping it. So that's why you can see bank deposit rates surging through the roof. OCBC, UOB, I think UOB one account just gives 7% plus. So we are knowing that the banks are wanting to suck up all the liquidity with increasing rates. So what I have here is something that's proprietary from TD Ameritrade and Schwab. So Charles Schwab bought over TD Ameritrade. Charles Schwab is the biggest in terms of assets in the US. So number one bought number three. We are now a bigger number one. So in some sense, this is a survey that we punch out on the October. So in Q4 itself, how many % of our clientele thinks about the recession, and how much risk are they going to put out there? So we know that around 70% of likelihood, you can see the top right corner, likelihood of recession is pretty much likely, 70%. So among them, there is an expected length of recession. You can see on the right box. 55% think it should range between 3 months to 12 months. So you can see it's pretty half and half. But the key thing is the risk-taking. So people still want to get invested in the markets, even if they know that the recession is coming. And we poll them, we ask them, hey, what kind of maybe investment strategy that you are trying to use? 63% are looking at equities, in fact. So which later on, it brings me to later on the portfolio solutions that I will bring up, as well as stock option solutions or ETF solutions. So despite having investments, but you can actually use strategies to ameliorate or at least mitigate the downside of your portfolio. Next, I have it's something different from Sam's coincidence indicator. It is quite similar in the fact that the Federal Reserve of New York is using some of the components within this conference board's coincident economic index, also known like the indicator for the recession. So in short, the summary goes that I put it in a very visual format. our own wallets will determine the income. So these are the indicators of the coincident. That means how early that the indicator can predict or forecast recession. So income from our wallets, and then salary comes from the employment, NFP, and then we have when we buy something is retail sales, and if selling to business is wholesale sales, and lastly, for the sales to occur, you need to create goods and services. That's production, industrial production. So in a visual way, you can see the highlighted sections are the recessionary kind of indicator by the index. So you can see this is from the Federal Bank of Philadelphia. You can take a look there. And it's a pretty interesting index that I will break it down into the drivers in the next slide. So this is something that goes into the nitty-gritty of what the index is, and it includes various aspects of the economy. So you can see on the left side, it is 2020, Jan 2020, and on the right side, it is Feb 01. Feb 01 is pretty serious, and that's why we want to use it as a form of comparison. So you can see the 2021 is because of COVID. The level is when we try to compare data between previous time period. So you can see it's pretty strong on the level. That means it's pretty on the same level. So, but then the trend, which is the direction or the gradient on the slope, it is dropping. So which means the virus is moving at a very fast pace, infecting even the economy at a very fast pace that the level is not really moving. And even then, during COVID, let's admit it, we are Netflixing most of the time and doing plenty of Shopee. So we are still spending in albeit a different form. But whereas in 01, there is a lot of fear and panic in the market. So whereby the level is really different, as well as the trend. You can see plenty of red marks around, and this includes the S&P as well as this is part of the LEI that I was talking on the previous slide. So it tries to bring in all areas of the economy, including the financial markets, to try to have a pulse on where the economy is and how risky is recession coming up. This is, right, so it brings me to my first tip. My first tip is shoring up cash reserves, right? So an illustration from our Schwab Center for Financial Research. We do have a financial research to go into personal investing and then seeing how the markets affects our wallets, our own retirement. So this is a hypothetical illustration. Two investors with starting 1 million, and then first one, they got drawdown. So they dip into their portfolio just to do some maybe personal emergencies and stuff, in which they dip into the cash reserves. So firstly, when you do that, you will realize losses on your portfolio. So there are floating, when you buy something or there's a portfolio, chances is a floating profits and losses. So when there is a downturn and then you are forced to actually maybe realize the losses, you are actually cutting short the potential that your portfolio can recover. So you just stop the recovery mode of the portfolio when it tries to rise up. Because you can see subsequently, from 3 to 19 is a plus 6% return. We are trying to ride up. At the same time, there's a drawdown at the same time. So drawdown means it's like I'm using it. For example, in your retirement years, you need to withdraw some money for day-to-day expenses. At the same time, you are fully invested trying to collect the 6% return. So by not drawing down or by creating cash reserves early, between 3 to 6 months of living expenses, you avoid drawing down like the first investor. So this is the second investor. Second investor, you can see that even though there's a drawdown later on, this is where the market hits. And then you still end up at the end of the day, up to 19 years of the investment period, you still have some money left. So the key thing, if you draw down early, you lose the compounding effect of the earlier years. And you really risk the retirement fulfillment at the end of the day. So the key thing is try to have some cash reserves during this time, even for a mild recession, have it some cash handy rather than, I would say, extend the tahanability of your portfolio. New word, tahanability. Second tip is to hold firm. Hold firm, or what we know is sit on hands. We sit on our hands and avoid trying to scratch the itch. So we know that when portfolio goes down, we start to have self-doubt. So people tend to, change the whole strategy, whole direction, tactical allocation. That one is itchiness. So try to avoid scratching the itch. Have laser focus on your own outlook. So if your goal is, you're more risk averse towards the end, or you're more risk seeking, so maintain that allocation. Don't try to, because of the wins in the markets, you're trying to change the whole directory. Imagine the market movements are like this. This is called the VIX, the volatility index. There are multiple jumps throughout the year, and then this is through multiple years or so, also on the Thinkorswim platform. What I'm telling you is that whenever there's a spike, there is a market jitter. So market jitters always happen. Like when you take a plane, there's always turbulence. So not just because of a turbulence, you are forced to change the flight path. Normally, unless there's really like exogenous event or a technical fault, then the airplane will change the route. But usually pilots don't really change the route because of turbulence. Same thing, we should not really try to scratch the itch from there. On the right side is okay to calibrate. So which means we maybe pair off. For example, if you have gone into an investment that went to stock splits and increases in value, so that area of your portfolio starts burgeoning, starts ballooning, so that you can pair off like bonsai tree. You snip into action, into right shape, so that it can grow as a nice overall shape instead. Then make use of the cheap market prices to go into underweighted sectors that you plan in your overall strategy. So remember, there's a big difference between scratching the itch and doing calibration over here. Next, I have some don'ts. So you know Brad Pitt, so the very handsome guy over here. And that film is Moneyball. So Moneyball, it is, I would say, they overruled during, back then. Back then, the scouts in baseballs, they are using very qualitative way to assess good players. So he comes in with statistics, and that is associated with the law of large numbers. So first don't is that on the right side, don't dip, like the first tip, don't dip, and always try to have an emergency reserve around. And then what I say, by dipping into the portfolio, that will reduce the risk mitigation efforts, because by the risk or insurance that you have, it is a portfolio. Your own portfolio is a sort of retirement insurance. So don't jeopardize by trying to shrink that safety net. Because when you start dipping into it, you'll start shrinking that safety net, and you are risking the retirement in that way. So that's why I mentioned the first don't. Second don't is don't try to be smart. So market timing is an self-ego. So we try to, I think this stock is good, I think that stock is good, I think my ego is better than the market. So don't try to be smart. Use the law of large numbers. So in probability, we try to, in trader speak, we call win rate. The more wins that you can get under your belt is better than one stock, like horse betting like that. So avoid horse betting, but rather play by numbers, collect the data, end of the day, do a review. Did I really go the same direction that I intended to? Am I overweight, underweight? So that is how a diligent investor should rather work during mild recession. Second, last one, I have tactical tweaks. So I did not have my Think or Swim platform over here, but there are these areas that you can consider when tweaking your portfolio. So tweaking portfolio, there is low-debt companies, good high-quality stocks that you can add on, as well as low volatility ones that you can add on to your portfolio. So if you have the Think or Swim platform or any other screeners that you have, you can input this, and then this will give you strong companies, maybe of lower volatility ones that can add on to a portfolio to augment it during this downturn. So remember, it's refinements, not wholesale changes. Last one, second last one, I have collar strategy. So like I mentioned in Mark Cuban's the slide earlier. So this is assuming you own 100 shares of Microsoft at $200. So in fact, I will show you later on with the platform that I created this collar trade to coincide with the 17 March FOMC meeting. So in case they really shoot all the way up, or some exogenous event, or Putin starts to do something wise, then I'll be protected and I can implement it now. In fact, it gives me a credit of $90. I would say not all the time is a credit outcome. Sometimes it's a debit. That means you pay for this strategy. In short, I know I own this stock and I have a definite profit target outcome. A profit target price that I can sell or call in. At the same time, I know recession coming, but how deep, how wide, how long, I don't know. All I know is that if I buy a put option, it gets me protected if price falls below the strike. Of course, we net off the $90 I collected lah. But so that hedge is doable. And how does it help you, even though you own, let's say, Singapore stocks, may not own US stocks? We know certain correlation that Singapore stocks have with the US markets, and the products that you can utilize do have like index options. So for example, like S&P itself, we have S&P index options that the options itself have exposure to the broad market index than particular stocks if you don't wish to go there. So, and for hedges, just to let you all know, it never is perfect. You can ask the investment specialist, it is never perfect. It is up to a certain point, but the key thing is you are hedged in a certain amount. It depends on how much hedge you want to put on. And then from there, the profit gotten from the hedge can be used to offset the losses on your portfolio. So this is the last one that I have, last slide. This is, I'm using the Think or Swim platform to do the stress testing. So you can see 200 shares of Microsoft at the bottom and the strike price of the various the options. So for those of you that don't have the platform, you can register an account, just the first page to get username and password, download the app. If you don't know how to use, drop us an email. We do have a one-to-one session where our US colleagues can give you a call, schedule a session, they can do a demo for you. So this is a more advanced tool. So for those of you like advanced, complicated, chim stuff, so this is it. So on the left side, on the y-axis, it is the profits and losses. On the x-axis will be the stock price. So over here will be the losses. You are actually capped or limited in terms of the losses if market really goes down. And of course, at the top side, when you sell the call, there is a take profit effect going on. Because you know three things. First, you have a position. Second, you know the impending downturn that is coming. Third, you know you want to take profit. So with all three, that's what Mark Cuban really have when he crafted the collar trade with Goldman. All right, with that, I think I reached time. And if you want more resources, we have the links here. The slides will be sent to you by the Edge. We have an education resources, the link over here, as well as the Learning Center for the platform. And I'll be together with the rest of the speakers with the, at the end of the day.
Our third speaker is Nirgunan, and he's head of consumer and internet at Alētheia Capital. And he will talk about sectors to watch for 2023.
Singapore is a great city-state, and one of the great things about this city is that people produce Christmas decorations before even Deepavali. And we even have the next year's investment outlook long before Christmas. So I want to congratulate the organizers of this event for their foresight and their unique sense of timing. Predicting the future is always difficult. It's often said that it's very difficult to make predictions, especially about the future. Nobody saw COVID-19 coming 36 months ago. Nobody expected a pandemic to wipe out communications and the economies of a number of other countries. And nobody expected that the pandemic would create an all-time boom in the stock market. Hence, whatever I say about 2023 and whatever my distinguished co-panelists said before me needs to be taken with a great deal of caution. Having said that, I will make you some bold predictions for 2023. There are three things that will take place in 2023 that investors may want to consider. First and foremost, more people will be going to the office because the pandemic will ease in terms of the restrictions. People will be encouraged to go to Raffles Place. Working from home will become less common as more countries ease the pandemic restrictions. The second is that more people will be traveling. My distinguished colleague from the UOB talked about the number of tourist arrivals in Singapore being less than half what it was in 2019. If we are just at less than half the level of 2019 tourist arrivals, can you imagine the traffic in this city when we get to 20 million arrivals? The third is that because of the higher interest rate levels, people will need to look for steady, cash-generating, reliable investment ideas. So on the back of those forecasts, I would like to talk about some basic themes. I have three objects to talk about. When people make forecasts for a new year in investment terms, they will give you charts and tables, just like my highly qualified co-panelist did earlier. I'm going to differ from that and talk about not charts and tables, but three objects. Three objects that all of us use almost daily and in many cases weekly. Three objects that you cannot ignore in 2023 as we come out of the pandemic. The first object is an object that we use when we go on holiday. It's the suitcase. The suitcase makes travel a lot easier. In fact, you would be surprised to hear that it was only in the late 1980s that people put wheels at the end of a suitcase. Before the 1980s, most suitcases actually had to be carried, just like you see in that Samsonite ad from the 1960s, where the gentleman is carrying the suitcase. There were more porters in most airports than customs officials. If you had landed in Changi in the 1960s or even the 70s, porters would be carrying the suitcase from the taxi terminal to the check-in counter. It was very difficult for people who are not very strong to operate a traveling environment. It was especially difficult if you were older. Today, we have suitcases that can be operated with wheels. We have branded suitcases made by companies such as Samsonite. Suitcases have become fashion statements. Due to the pandemic, hardly anybody bought suitcases in 2020 and 2021. The sales of suitcase manufacturing companies were completely wiped out. They were gathering dust in the showrooms. But as more people take to the skies, we will see a tsunami of travelers going to airports carrying suitcases with wheels underneath it. And not only will they have wheels, in some cases, people like Samsonite and the other top suitcase manufacturers in this world are coming up with something known as smart suitcases. These are not suitcases that look better than others. They look exactly like any other suitcase, but they can be traced. They can be sourced. They will have some of the features that the iPhone has, where you can recover a lost suitcase. But that's just icing on the cake. In the case of Samsonite and the others in the suitcase industry, their sales fell by 80% in many cases, and just like tourist arrivals have collapsed in Singapore, and they are bound to recover, 2023 may be the year of the suitcase. The next item that you might want to focus on is an item that most gentlemen in this room are familiar with, which is the razor. Virtually every adult in any country, at some time or the other, adult male, would probably use the razor, some more frequently than others. And the man that you see in this photograph is Mr. King Gillette. He was an entrepreneur about 100 years ago, and his great invention was to create the safety razor. He realized that if he was able to provide a razor that could be used on a regular basis, where the blades would be disposable, where the blades would be cheaply made, he would be able to create a model kind of like what the printers are right now, or the Nescafe coffee makers are, where you subsidize the cost of the razor but make money on the blades. And his product is used all over the world. The Gillette razor is the Rolls-Royce of razors. And as more people go to the office, people will be buying more razors, because during the 2.5 years of the pandemic, the people who were working from home were growing beards. They were not maintaining themselves in the same manner. So the sales of items which are linked to people's professional appearances, such as razors and such as the formal clothing that's associated with traveling to Raffles Place and other centers of our professional lives, will increase dramatically. So watch out for the sale of razors, and if you can make an investment that gives you exposure to that, that may be a solid investment. The third item is also an item many of us use every day, There again, some use it more frequently than others. It's the soap bar. With high interest rates, we need to look at companies that produce goods that are reliable, that are safe and steady. And one of the great virtues of what's known as the FMCG companies, the fast-moving consumer companies, such as Nestlé's and Unilever, is that they produce goods that are used on a daily basis. Lux soap is one of them, Rinso is another. These are brands that every one of us is familiar with. 75% of the goods sold in the NTUC supermarkets are produced by 10 companies. Whether it's the pandemic or whether it's the post-pandemic era, whether it's a recession or a booming stock market, people will continue to use these products. This is a typical supermarket shelf. These are the goods produced by Unilever. They're used for cleaning, for household maintenance. And the great virtue of investing, if you were to invest $10 30 years ago in Unilever and Nestlé's, you would have outperformed the S&P 500 by a factor of 35 to 40%, which is a huge amount over a period of 30 years. And the other interesting aspect of that chart is that you would have vastly outperformed the S&P 500 during a bear market. These are companies that deliver steady and safe returns during good times and do even better during bad times. So those are the three aspects or three goods that I would like you to focus on. I'm not coming here with a stock recommendation. I'm not coming here with an investment strategy recommendation. I'm telling you to focus on three inanimate objects. On that note, I stop for questions.
When we had this discussion this morning, the one elephant in the room that wasn't mentioned was China. What's going on?
Okay, so for China is, okay, all the news right now is on all the pandemic and also the lockdowns, the frustration. And one of the things is we think that this is going to kind of moderate going forward, because I think the Chinese governments, they are signs that the Chinese government may be loosening at the edges on the margin. One of the things is that the difference between Singapore, we also had our lockdowns, right? And China having its lockdown. One of the things is that for China, it is quite draconian. You can see that they locked down the entire apartment and all those things. So that's, I think they're going to improve on that, right? We speak to some of the people from China who know more about China than us. I think the view is that there will be some loosening. So we are hopeful that the situation will improve. The other thing is the property market, right? The property market, we hear a lot of bad news. I think the most recent price index, I think, dropped about 20-something% year on year, and then the volume is also down. I think the government has come out with some support measures already, right, earlier this month. So that would, I think, help to support some of the activities there. We are also hopeful on that, because if you look at the China property market, those that are in a bit of trouble are the second tier, third tier, fourth tier cities. And the first tier cities, the prices are expensive as ever, and the demand is as strong as ever. So those are the smaller ones. So hopefully going to next year, we are hopeful that the visitor numbers will get really boosted when China relaxes its measures, and your suitcase companies from Nirgunan and all will get a big boost. Yeah, Goola.
So what about the property companies that have problems with the offshore debt? And some of these are very big. There's Evergrande, I think there was some problems with Shui On land as well at some point, and some of them are big companies. So will that have an impact on the broader economy?
In terms of a broader economy, it's not so much at this point, although they are so concerned. But if you look at what the exposure for the biggest banks in China, right now I think the NPLs on mortgage-related activities are still quite okay. So I think the government is not so much concerned of that, but the more concerning is of course the supply chain related to the construction of properties, and also companies that are related to that. So I think the government is more concerned about those rather than posing a systemic risk to the system. We just, 2 months ago, the IMF representative from China based in Hong Kong came to our office and we spoke to the IMF representative. What they said about these China property related exposures is about 4% of China GDP. Hey, that's still quite a bit, but it's only about 4%. Whereas the government support at the time, that was in October, around about 1% for that. So there's some mitigating factors. It's not a big problem, but it's still a problem nonetheless, and the government is looking for steps to address that without creating the moral hazard problem where you get into a problem, the government come and support. So they're trying to do it in a slow and steady fashion rather than coming in with a big rescue package. Goola.
Okay, thanks so much, Teck Kin. Okay, so before this morning's speech, I realized that these risk-free rates were coming down. Now, Teck Kin has a different view. He thinks they're going to go up again. But in the meantime, Nirgunan, is there an impact on cost of capital? Will equity prices rally at all? Because these risk-free 10-year treasury rates have come off, and our 10-year yields on the 10-year SGS, Singapore government securities, have come off. They're below 3% now. It was 2.98 on Friday.
It's possible that the market would welcome it and the equity prices could go up, but we are still in the early days of the change in the trend, so the market would need to absorb it.
Okay, so you don't think that suddenly equities are going to attract attention?
It could cause a change in sentiment, but as I said, it'll take a number of weeks for people to absorb the data. But broadly speaking, for 2023, there are 3 scenarios that investors will be focusing on. One is evidence of the Fed changing its stance on the interest rate hikes. The second is a possible reopening in China. And the third is the easing of the Russian-Ukraine conflict. If those 3 things can be resolved, then we are back in action in terms of the equity markets.
Okay, all right. Okay. So, Teck Kin, do you think that these risk-free rates, even though the Fed's rate hike cycle has reached a plateau, do you still think the risk-free rates are going to rebound, come back up next year?
Yeah, correct. For the 10-year, if you are talking about 10-year, we are still expecting the risk-free rate, the 10-year treasury yield, to move back up to 4%. Right? So right now it's about 3.6, 3.7%, something like that. So you think about the Fed funds rate, there's still 50 basis plus another 25. So it's about 100 basis from here. Right? So based on that, so we think that it's going to hit above 4%. Hopefully, it will be stabilizing at about 5% for the Fed funds rate, and then we'll see the stabilizing in the 10-year yield as well from that. But I just want to go back to Goola's question on the cost of capital. The 10-year yield forecast that we have right now is about 4.2% peak from 4.5% peak that we had just before Friday. Now, even if with a lower risk-free rate for companies, the cost of capital may not come down so quickly like what Nirgunan said just now. One of the things, of course, all these factors, but for the individual companies themselves, it also depends on their borrowing profile, right? The borrowing rates. They might have locked in the rates for next few years. So even if your risk-free rate comes down, you may not be able to benefit for your existing one until you refinance. Second thing, also depending on the individual company's the profile, right? if the rate comes down, for example, 10-year yield comes down because of, let's say, the recession risks have gotten so bad, right? The outlook has gotten or turned negative, so rates come down. So that could affect the credit spread as well for companies. So even the yield comes down, because of the situation is not in favor for that company, the credit spread will actually increase. So it depends. So it may or may not cause the cost of capital to come down for companies, Goola.
Okay, all right. Okay. So, Leonard, it's your turn now. Do you think there is any fallout from the FTX problems and the crypto assets on the real world? On the real world. I mean, this is all in some other world. Crypto, metaverse. I don't know these things. I've not been there.
Sure. We can't really speak too much on crypto itself, but overall speaking, you can see Temasek has exposure to FTX, and they have given out reassuring statements regarding FTX. And more information are being developed. We can see like how many Singapore accounts are opening with FTX, so on and so forth. But the key thing, remember, it is crypto. There is no tangible assets that, unlike gold, unlike currency, that is held on or derived the value from. It is something that is very speculative. It must be done with a pinch of salt. So even if, let's say, you want to add some risk to your portfolio, be very careful when you step into crypto from there.
Teck Kin, do you have a view on crypto? Everyone's got a view. You'll have one too.
You want me to? Okay, I don't speak for the banks, but we have a team member actually part of this, we call it blockchain working group, right? Blockchain working group. The blockchain working group from the very beginning has already decided that crypto is not the area that we will dwell in, right? It's not the area we'll go into from the very beginning. The reason, very simple, like what Leonard mentioned, there's no tangible value. So if you had tangible value, you would not have used dollar to back your asset, right? If you had tangible value, because precisely there's no tangible value. So and so speculative, blah, 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 and all those things. So from the very beginning, so our focus from the blockchain workshop, like other things, for example, CBDC, how does it, central bank digital currencies, how do we play a part in the central bank digital currencies? If you look at what MES is doing, is also that direction, not so much on the cryptos, but how to use this technology to help improve the payment system, to help improve your central bank digital currencies, etc. So again, I think maybe I just want to echo what Leonard said. I don't have much thing to say about it, but be careful dwelling in that or moving into that space.
Crypto? Oh, by the way, how many of you have invested in crypto? Right, over to you.
What's the
Crypto. Do you think there'll be a fallout from FTX and the crypto assets in the real world? And,
So far, the contagion from the FTX blow-up has been restricted to its direct counterparties and others who are broadly in the crypto space. Whether it has systemic risk potential along the lines of the Lehman blow-up in 2008 does not seem to be particularly likely at this point. So the contagion seems to be contained within a restricted space.
Okay, so I suppose that's taken us all off the crypto, if there ever was any interest in it. Right, there's some questions from the floor, and the one that's got the most votes is this on, okay, so I think, okay, hang on, let me say, China, Russia, Saudi Arabia are unhappy about the high US interest rates. I'm unhappy about the high US interest rates. Are you unhappy about the high US interest rates?
To some extent.
Yeah, we all have loans.
We're all unhappy. Okay, so they are buying up gold to dethrone US petrodollars and set up a new currency. Okay, we'll ask that question to Teck Kin in a minute. Without Saudi support, will the dollar crash? Okay. There's no new currency.
Okay.
There's no new currency at the moment. There were attempts at getting a petro yuan off the ground about 7 years, 5, 6, 7 years ago, and has that happened?
Okay, I think in that space, what happens at the most recent news is trade between Russia and China. More and more of it is denominated in the Chinese currency, right? Because of under sanction, Russia has no access to dollar, no access to euro, and the safe way out is to trade in yuan for their trade settlement. And I think there are some numbers. There are some numbers from the Russian side pointing to that direction. But is that going to be a widespread development? That may be still some long way to go because the dollar is still the reserve currency of the world, and Federal Reserve, the US Federal Reserve is still well respected as a central bank, and there's still a lot of trust. So the dollar will remain for a while, whether without Saudi support. I think Saudi will still continue to sell their oil in dollar, right? And then other buyers will still settle in their oil in US dollars at this point. I don't see any major change.
It'd be interesting to see what India settles their Russian oil ships. Do you think so? Do you know what they settle it in? I think it's in US dollars.
In US
it's
dollars.
In US dollars, yeah, because that's other large buyer of Russian oil now. So, yeah, okay. So, question to Nirgunan: what and where to invest in 2023? You're going to repeat your 3 stocks, or?
I urge people to focus on 3 objects rather than 3 stocks. So once you figure out the prospects for those objects, you can work out a portfolio on the basis of your own risk profile.
So Leonard, I think TD Ameritrade has some sort of an index where you show who are buying and selling stocks and what stocks are being bought and sold. So what are people investing in now?
Currently, there are certain sectors, like I think energy. We cannot escape, like under inflationary circumstances. Energy is a large portion of everything. The other one with very strong income, it is consumer discretionary. So, like I think travel-related stocks like Marriott, like the Hyatt Regencies, even some of the airline stocks do when it comes to this area. Then undervalued ones will be like financial. So it depends. I think we have an off-the-cuff conversation with Teck Kin. Sometimes the FIs or financial institutions may benefit from rate increase, but they have to balance off with the bad side of the business. So you have to really look at the mechanics of the financials to weed out the weakest ones.
Okay. Do you have anything? You've got your 3 objects, right?
Well, there's no doubt that the travel stocks that you mentioned would be potential beneficiaries, but travel as we know it will not be the same in the post-COVID era. Before 2020, the class of travel stocks that would benefit from a travel surge were different. Today we have other options. Online travel agencies such as Expedia would be an exponential beneficiary compared to traditional travel stocks such as Hyatt or the airlines. So there may be even better potential if you combine a belief in travel's revival with a bet on the digitalization of travel.
Okay. All right. And another question that's got a lot of votes is, with China easing on COVID restrictions, how would that affect the 2023 playbook? I'm going to ask Teck Kin, will that cause inflation? And what will that do to things like inflation if China opens up?
Okay, wow. This is difficult to answer. This question is difficult to answer. But right now, what we can say is that China's inflation rate is still quite low. Okay, maybe it's a product of the restrictions of business activities, etc. So there might be an element of that when they open up. You can imagine, just now in Singapore, we have 5 million, whatever, 4 million visitors so far this year. The peak was 20 million. Can you imagine it's open up, then all these travelers coming in to Singapore? You can imagine your hotel rates, your food prices, your restaurants, your transport demand, etc. That could potentially will have inflationary pressures on places like Thailand and Singapore, etc. So that's one scenario, right? But you have to think about the other part is that these are services. The other part is that China has been the world's manufacturing center, so that actually helped to offset some of the inflationary pressure if their supply chain and their factories operating without restrictions, etc. That actually will help lower goods prices, Goola.
Okay, so that sounds like it's better for the West because they get lower goods prices, but we have some inflationary pressures here.
But we do import from China as well in terms of goods, right?
Okay, so we've got a question which has also have a lot of votes, and I also want to know the answer. Do you foresee equities in the Singapore market coming down further? I'm going to start with you. I'm going to go through all of them.
It's difficult to make a specific prediction for 2023, but you need to understand that Singapore is exposed to some of the principal factors that will drive the recovery. We have a large number of travel stocks. We have a high number of yielding stocks. So if there is a switch towards yield to countervail the high interest rates, then Singapore could be a beneficiary. So I think on a balance of probabilities, the chances of an SGX upsurge in 2023 outweigh that of a poor performance of the SGX.
Teck Kin, do you have a view of the market?
I hope so, that Nirgunan is right. Again, I think we have to see the balance of some of these risk factors. Russia-Ukraine conflict. Some of these are geopolitical tensions as well. China and US related to Taiwan, technology, etc. We are already seeing the tech sector coming off. I think one of the reasons is, of course, the restrictions on supply to China. So the tech sector is already, a semiconductor cycle is already coming down. And we saw our NODX, non-oil domestic exports, first contraction seen in 22 months, after 22 months of expansion, first contraction. So there's something to pay attention to. Some of these are risk factors, but I do hope that the STI is on the upside as well, as I'm sure many of you do too. Thank you.
Leonard, you know you're with the US market, but do you look at the Singapore market at all? No.
No idea.
He's got no idea. Oh,
Yeah,
no.
I'm very focused on the US side of the business.
Okay. All right. Okay. But we can still buy some of these US ETFs on our local market. You know, the Spider, S&P, and so on and so forth. All right. Okay. Okay. So the next question, still on the stock market. Do you think the equity market has priced in earnings contraction? That's the first question. Yeah. Do you think equity market in general? Not just Singapore. In general. Because there's going to be a recession, mild or not mild, but you think?
Well, the principal stock market indicators are down nearly 30% for the year. Given that drop, one has to assume that they have taken the prospect of a recession very much into their considerations.
Okay. Do you think as
I would think along the same line as well, because it's also related to the Fed rate hikes, right? The Fed interest rate, we could see the other day when the October CPI report came out, right? The market was like, wow, so excited because the number came off, and the Fed may pivot. But you know that with these aggressive Fed rate actions, I think multi-decade, in the most aggressive in the past few decades, these sort of aggressive rate hikes is going to cause some problem for the economy. In fact, we are seeing next year for the US, probably we will have a contraction in terms of its GDP, right? A contraction together with Europe and UK as well. So I think the stock market probably priced in some of these developments already to a certain extent.
Leonard, are the US analysts all forecasting lower earnings for the next cycle, for the next 6 months, 12
They
months?
are pretty much on the same page. They are kind of predicting the recession to hit this year end, in fact, and then it should roll out to mid of next year. That's the latest. So plenty of even the CEOs like Jamie Dimon, they have already said in advance. So even like Elon is already positioning for it. So hence, if the heads are moving, chances is the rest of the retail traders are creeping along.
Okay, so the question about whether the company's management guidance, they're all guiding for lower earnings, unless you've seen other than that. Okay, so could we talk a little bit about Malaysia, truly Asia? Malaysia. So do you think Malaysian equities are reacting to the new political situation? That's the easiest way to put it, the political situation.
Malaysia's equity market has exposure to some of the principal trends of 2023, but beyond that, there are some structural issues in Malaysia. One is that with the GDP per capita around $11,000 to $12,000, it's reached what's known as a middle income trap, where it's very difficult for Malaysia to continue to have an edge over other developed countries in terms of a manufacturing hub. So the country needs to figure out what the next phase of growth is going to come from. Irrespective of the political winds of change, the politicians and the policymakers may need to focus on that objective.
So UOB has a big operation.
Yeah, we have a big operation in Malaysia, but not so much on the equity market.
Yes. It's the biggest foreign bank.
Yeah, biggest foreign bank in Malaysia for UOB. So we are more focused on the business side of things. So of course, I think because of the Malaysia, the economy is very, part of it is tied to the semiconductor cycle as well. So there is now the risk of these semiconductor turning down. So those sectors that are related to that will be affected, including the supply chain, right? Not just the direct exposure, but the supply chain as well. But overall, for Malaysia, with the new cabinet, new government settled down, I think there's some positive reaction for the equity market and also for the currency as well. So that's something that's good. Hopefully the new government will come out, we expect the new government to come out with more pro-growth policy. So that should help to mitigate some of these downturn due to external factors.
And I'm sure tourism will pick up too.
Yeah, tourism hopefully will continue to pick up. The causeway is jammed like every day.
Leonard, do you have any thoughts on Malaysia? Because you don't follow the Malaysian market.
No, I'm sorry. No, it's out of my expertise.
Okay, right. What about the outlook for the Singapore dollar against the US dollar? Do you have a view on that? That's important, quite important for you, for your information?
I think from the strengthening, it is continuously strengthening for the Sing dollar. So you can see MAS is very aggressive. And for us, we see more deposits during this time, taking advantage of a very favorable Sing dollar rate. So we see for clients sending in more money, including our banking ops, they are working overtime. So I think that's a proxy from a very ground feel on how the US Sing rate is going on.
Do you have, sorry, Teck Kin, what was your view? What was your rate against Sing dollar against US dollar? You had a forecast.
Yeah, we do have a forecast. So, the main driving factor is still US dollar. Okay, the main driving factor is still US dollar. It will determine for everybody else, including Sing dollar. So our view for the dollar is that it will continue to stay strong, at least through the first quarter of next year. The reason being US Fed continue to hike aggressively, even at 50 basis points, it's still quite aggressive compared to the rest of other central banks. But for the Sing dollar itself, so that means that will still have some room to weaken against the US dollar. The weakening has been mitigated or offset somewhat by the MAS actions. MAS has been very proactive since October last year. Can you imagine, before even the Fed has started to move, Singapore, MAS, Monetary Authority of Singapore, our central bank, has already started moving last year. And you know what? All of us here, benefited from that, because the Sing dollar, on a relative basis, although weakened against the US, on a relative basis, we are ahead of a lot of other currencies. I mean, Japanese yen. Japan is a favorite destination for many of you, I believe, right? So Sing against yen, so 100 yen from about 80 yen to 100 yen. So I think a lot of people are very happy. But coming back to Goola's questions on Sing dollar exchange rate, we just adjusted our Sing dollar exchange rate last Friday. Still a bit weaker, but let me give you the number. That should be still weaker. Last Friday was around 1.36 or so, 1.36, right? So it moved, it strengthened quite a bit, but we still expect the Sing dollar to move toward 1.40 towards towards the middle of next year. 1.36 and then 1.38 or so, 1.4 against the US dollar by middle of next year. So right now, it's still quite low. I think it's still enough time for Cyber Monday, no?
But what about the tourists that come here? Will it be too strong for them?
Okay, for the tourists, I think sometimes the currency is one thing. You go to a place, especially if you're coming from a place you repressed for so long. I mean, just like for many of you, I'm sure, once the restrictions were lifted, you just grab whatever tickets available and then go to the next destination, not just because of the currency, right? So for Singapore, it's in a very good place, because we are, to many foreign tourists, Singapore is very safe, very convenient, compact, convenient, and also well connected to many places that you want to go. So a lot of these are regional tourists. For example, they will come to Singapore, despite you have Malaysian colleagues coming to Singapore, complain very expensive, but they still come here because it's convenient, it's safe and connected to the next place that they want to visit.
Do you have any view on the Sing dollar against the US dollar?
I don't have a specific view on the currency, but I would certainly endorse the view that Singapore as a hub is going to attract more visitors because exactly the same features that you talked about.
Yeah, not just for retail. Remember about 1 month ago, MAS released a set of numbers talking about investments in Singapore, investment flows, record 448 billion came into Singapore last year. So a lot of these are professional investors, family offices, and other institutional investors. 448 billion, that is a 16% increase over 2020. 16%, that's a very strong number, because before 2021, the number was hovering around 300 plus billion per year. So we saw a very strong surge, 448 billion into Singapore last year. So that's a testament to Singapore's safety, being safe, connected, and after the COVID experience, people saw what Singapore government was able to do, the assurance that they gave to not just Singaporeans, also foreigners who operate in Singapore. You operate your companies in Singapore, you are still qualified for the, of course, certain conditions. You still qualify for the government assistance and all that, not because, not only just Singapore companies, but even foreign companies, as long as you meet the conditions, so they don't discriminate.
So the job security, that job scheme, job support scheme as well.
Yeah, job support scheme, you know, the loan that you can get, loan subsidy, interest rate.
etc. So that was very good. But the point there is, what was I going to say? Okay, I've lost the thought.
We'll talk about it after.
We'll talk about it afterwards. We'll talk about it afterwards. There's a question here on Chinese banks told to support the property sector in China. There's no question here, but I'm just wondering, what are your thoughts? Is it with the government support in the Chinese property?
For me to answer? Okay. So if you take a look at all these banks in China, the big four or whatnot, those are in a way, state-owned enterprises. So in times of difficulty, the government will direct them to do something along this line. Of course, I think the government is also aware. We have to remember these are Chinese government, their officials, they are very smart people. If you have dealt with them before, they are really highly qualified. The civil servants and all those, they are really highly qualified and they know what they are doing. So they are also aware, if I direct you to do something, it's only to a certain extent, right? Not all out. So there are still some KPIs to meet, and also these Chinese banks are also listed, right? So they also have to be responsible for their shareholders. So these are the considerations that they need to come out to support, but at the same time, they also have to be mindful. So I'm sure they are all aware of these, the balance that they need to take.
Okay, so my thought was this. The all currency money supply, M3, has been going up all year. Yeah, and it's all gone into which market? Our property market. That's the observation. Okay, I think we're out of time. So, yeah, okay, so we're almost out of time. So the question here, okay, there's a question here that I think I would like to ask. To what effect will the current yield curve inversion occurring in US Treasury bonds, which we're talking about the 2 and the 10, and it's also in our Singapore Singapore SJS, yes, 2 and 10, affect inflation and affects the recessionary outlook? I think that should be the question, yeah. Both for US we've talked about, but what about Singapore? Because that's very clear, the 2 year is much higher than the 10-year.
Okay, the 210 in Singapore, okay, in 210 in many markets, including the US, inversion is common before recession. You know, that's what the talk before recession. It has a very good predictability power for the 210 curve in the US and other places. But it's not 100%. It's not 100% correct all the time, but the predictive power is quite strong. But for Singapore, the 210 inversion is actually quite rare. It is not a common occurrence in Singapore to have the 2-year yield higher than the 10-year yield and persist for a long time. Unlike the US, the 210 can persist for a long time for the 2-year higher than the 10-year in the US. But in Singapore, it's very seldom to happen. That it does happen from time to time. I think recent months, it happened before. I
think about 4 or 5 months. We've had it for about
4 or 5 months. So it's not a usual occurrence. I think because of the market structure that we have, it's not that liquid. And also a lot of institutions, they buy and hold rather than trade. Right, so it's not that. I think the recent one also, I think it's quite short. From time to time, it bounce back to the normal 210 version. Is only occasional that you will get to negative.
But the two is well above 3, whereas 10 is just come below. Yeah, so it's
yeah, correct. So you do have that, but it's not a usual occurrence. So it's going to I think will be revert to the normal,
Oh,
hopefully
okay.
so.
So that 6-month Treasury yield play looks like it's over. Everybody's looking at it. Okay, I think we really are out of time, but I would like to make one plug for UOB. The points about ASEAN, the visitors in ASEAN rising and ASEAN economies rebounding. Well, I think there's one play that has it all, and that's their bank. And you're going to get even more ASEAN next year when Vietnam, when the Citi acquisition works out.
Yeah, so ASEAN is important. I think not just for UOB, I think it's also for Singapore. It's our backyard. So you want to hope that they do well so that we can do well, right? So also a major source of tourist demand is also from ASEAN, right? So in terms of their domestic economies, it is also very strong. All the rebound, the chart that I show you, the rebound is ongoing. So that will be helpful to Singapore. Their manufacturing sector, one of the things that is happening is, I just read a Bloomberg report today, just only, the solar panel manufacturers are being investigated by the US because many of these Chinese companies, they produce in Southeast Asia. I think Vietnam, 30%, over 30% to the imports for solar panels, 31% is from Vietnam, 30% is from Malaysia. Thailand is about 18% or so. So a lot of this supply chain shift is happening, but that would be good for us because you will benefit. Right? Okay, US investigation is one thing. So this is one of the things that is happening in Southeast Asia. Supply chain shift benefiting our neighborhood, including Singapore as well, because many of these companies, before they go into the regional countries, they will come to Singapore first, establish a head office before they branch into the region. So it will be a benefit. It's a benefit to Singapore and to ASEAN.
And to UOB. So on that very happy note...
OCBC and DBS too.
OCBC and DBS too, yes, okay. And on that happy note, we've come to the end of the morning. We've had, I think Jackie has a bit, but first of all, I must say that we've had some overview, we've had some objects to look at, we've had some stock discussion, and over to you, Jackie.
I think there's one more question that one of them specified to us, Leonard. I think in your presentation you talk about the law of large numbers, so the person wanted to clarify if it's the same as diversification.
Right, so diversification is different. Law of large numbers, it can include diversification. So law of large numbers is like many data points, and then drawing in scientific term an R-square, a curve. And then when you hit many wins, rather than, like you go betting, let's say you go MBS. So you go banker player, then you bet on and win more than you lose, then that's the law of large numbers. When diversification is just don't play one game, play many games. So instead of just playing banker player, I'm not encouraging gambling, I'm just using it as an analogy. So there are multiples like maybe horse betting or soccer betting. So there will be different games for you to play rather than focusing on just getting the numbers. Getting numbers is just a single game from a single activity. So that's the big difference.
Okay, thanks. If you want a diversified portfolio, which is the other side of the coin. That's the other side of the coin. So you can just go to the ETF and get an S&P ETF. So yeah. Okay, so thank you very much.